heck happened to Ellie Mae last week, the provider of cloud-based mortgage origination software? It streamlines, automates complicated process creating mortgage. Last Friday, the stock got eviscerated. It plunged 17% in a single session after the company reported a quarter that was definitely shy. What's going on here? Okay, Ellie Mae's problem is that it's a fast-growing company where the growth is slowing, and they just disappointed, delivering a top and bottom line miss with much weaker than expected guidance for both the quarter and the full year. Now, what's the culprit here? Ellie Mae's software is all about mortgages, but they saw a major decline in refinancing, and there weren't enough outright purchases to offset that weakness. The other issue is that Ellie Mae's growth has slowed dramatically. It's down from 42% last year, maybe 11 to 13% this year for the number cut. Still, the stock trades at 35 times next year's earnings. That means this decline might be a buying opportunity, but if things don't get better, then maybe we should be more cautious. Let's take a closer look with Jonathan Corr, the CEO of Ellie Mae, find out more about how his company's doing and where the mortgage industry is headed. Mr. Corr, welcome back to Mad Money.
Thanks, Jim. Great being back here.
Okay, so Jonathan, I'm trying to understand exactly what happened. On the conference call, you indicated that the mortgage market had transitioned from a refi-driven one to a purchase-driven one to a degree that you haven't seen since 2013. Can you tell me what happened?
Yeah, absolutely, Jim. I mean, we had a lot of things that we're really happy about this quarter, fundamental drivers in terms of bookings and new customers and progress on our lending platform. And we're growing, quite well in a market with some headwind. But the refi transition, although we expected it, had a bigger impact on a number of our customers than we initially projected. And just some things that we didn't model because we really haven't gone through a transition like this. But we really believe we're through this transition. The purchase market is solid and growing, going forward. And the fundamentals of the business, in terms of picking up lenders, driving more loans through the system, and driving efficiencies, still is very solid. And we have a lot of confidence in our outlook ahead.
Okay, that may be the case, but I talk to every single home builder, and it does seem that there is a shortage of homes, that you can't necessarily transition the way you'd like to because the inventory is not there. So you yourself, sir, can't create inventory. So how are things going to bounce back?
Yes, we can't create inventory, but the projections that are out there already take into consideration that the market is tight, that inventory is tight. So the demand curve out there is very strong. And it looks to be strong and getting stronger as we go through this year into next year and beyond. Now, the fundamental drivers of our business are independent of residential finance volume. I mean, the underlying drivers of the business are all about us picking up lenders, driving more efficiencies, driving more loans across the platform. And it really is a network effect and driving more revenue per loan. So yes, if volume is behind us, it's a tailwind. If it's in front of us, it's a bit of a headwind, but the fundamental drivers of the business are strong. And on the purchase side of the market, I am starting to see, the economics of people embracing and new housing starts. We saw in June a big jump up from what we were seeing over the last few months, and I think that's a reflection of as you have demand that outstrips supply, pricing starts to go up. As pricing goes up, more and more builders look at the economics and say, boy, I should take advantage of that. And, we're starting to see signals that is part of the mix right now.
Okay, so in other words, that would presume then that there was a good linearity here, that maybe the beginning of the quarter wasn't that strong, but it gained strength through the quarter. Is that true?
I think we went through the transition in the first half, and the refi kind of diminished as we went from Q1 through Q2. We're now in a place as we go into the second half that what's going to drive business is purchase. Okay. And as we look into next year and beyond, we've gone through that transition. So the fundamentals are strong.
So the gross margin contraction may be at an end and we might be at trough here?
Yeah, we think that's the case. I mean, the gross margin is a function of the investments we've been making and obviously where the revenue level is. What you continue to see is us, really focusing on what we look at as the bottom line, more the the EBITDA and the cash flow generation, which, puts us, it was 34% this quarter. Mm-hmm. And as we look forward, we continue to expect to see that expand as we go into next year.
And we're sure that there's no one else that's come in and taking share from you. You are still the share taker from the old-fashioned way that people do this.
Yeah, absolutely. I mean, fundamentally, bookings are solid. 10,000 bookings this quarter, almost 22,000 year to date. And our next generation platform that we've started rolling out in terms of concept releases and talking about is attracting bigger lenders to the mix. I mentioned we signed one of the top 3 national federal credit unions, mm-hmm. and we signed and deployed the 4th biggest correspondent investor in the marketplace this quarter.
All right, excellent. Well, I'm glad to hear that things are, that maybe you got some tailwinds instead of the headwinds. Jonathan Corr, CEO of Ellie Mae, ELLI. Thank you so much, sir.
Thank you so much, Jim.
Okay. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.